All right. Good morning, everybody. Welcome back to another episode of the Tim and Tim Show every Tuesday at 10 a.m. Eastern Time. And this week we're talking about a hot topic, and it's directly correlated to what's going on in the stock market today. So we're going to dive into refinancing. I mean, this isn't really everything we're going to talk about today is not specific to refinancing, but it's a phase of life that Tim and I are going through right now, and it's relevant to us. And the stock market is down a lot year to date. I think around 17% or something like that. So what does that mean? How is it impacting commercial real estate values? How is it impacting the treasury yields? What does that mean? How are those impacting commercial lending rates? We got a lot of information packed in today's show, and I'm super excited to talk about it because it is something Tim and I talk about all the time between ourselves. And we decided we're going to talk about it publicly now. So, Tim, how you doing today, man? Are you ready to dive into this exciting topic because it's been so relevant?
Yeah, doing even better now that I realized I moved my positions into a more cash position and out of stocks about a week
Hey,
ago.
Um, yeah. Also, I spoke at the My First Million conference last week on Tim and I's behalf, and somebody and I told everybody about our show, the Tim and Tim Show, and somebody in the crowd said the Tim and Dennis Show. It's good to see you, Dennis. Glad you're here as usual. But missed you
That's
in Charleston last week. All right, so this year we're talking this week we're talking about. Oh, good morning, Joe Bisbing as well. Good to see you, buddy. All right, this week we're talking about treasury yields, and the golden standard for commercial lending rates is tied to the 10-year treasury bond. Um, I truthfully, I don't really watch the 10-year as much as I watch the 5-year, because generally when Tim and I are going through a refinance or an acquisition, we're putting 5-year debt on our loans. And the 5-year loan is correlated to the 5-year treasury yield.
Yep.
10-year loans are tied to the 10-year, and 1-year loans are tied to the 1-year treasury, right? So et cetera and so forth there. They're all tied to the relative time frame. Um, One of the things that's happening right now with the stock market declining means that people are moving money out of their yield bond positions, and they're moving them into equities. What that does is it pushes down the treasury yield rates, and the treasury yield rates are tied to spreads that are tied to how you get your commercial lending product rates, right? So typically a bank or a lender will borrow money from whatever they can get it at from the government, which is on the bond rate, and then they'll attach a spread on top in order to make their profit. Generally, the spread is keep me honest here, Tim. What are the spreads that we're seeing? Like 1.5 to 2 basis points higher? Is that correct?
They're usually 1.5, 1.75 to two, right in
Yeah,
there.
so somewhere in that general range. Each lender is going to be a little different. You have your option to do buy downs. You have your options to negotiate rates a lot. But traditionally, when you're refinancing a stabilized product, at least in our world, we're refinancing with a Fannie or Freddie product, depending on the
Yeah.
market and the size of the deal. And those lenders typically are based off of the treasury yields.
Yeah, so like the conversations we've had in the last couple of weeks have been typically market rate products, so market rate assets, typical, non-affordable, non-low income. The spread's usually about two. When you get into the affordable stuff, the spreads are dropping at about 1.5.
Yeah.
Um, so
Um, but with the stock market kind of being quite volatile right now, it makes investors sentiment as a whole pretty scared, for lack of better terms. I was trying to think of a more eloquent way to put that, but really it's people are kind of in a wait and see mode, and that includes banks, because banks are investors ultimately. And when the treasury yields are moving a lot and the stock market's moving a lot, they're all kind of in a wait and see what's going to happen. We're not going to deploy money until we kind of have a better outlook or better perspective of the optics of the risk, right? Because investing is risk, people. Let's be honest here. And when you have such volatility in the markets, it makes it more difficult to get lending terms. And for my goodness, has it been ever true? I mean, the amount of detail and questions and back and forth that we've been getting with the loan committees, with the loans that we've been trying to do, have just been like where are all these questions coming from? Like, we've never been asked some of this stuff
Yeah,
before.
all the way through. I mean,
All the way, even the day
not
before closing.
not just agency guys. Like we've gone with some local credit unions and local banks, and right up to loan committee. The day before you're supposed to close.
Yeah.
And it's taking a long time.
Yeah.
Um,
How long did the last refinance that we just did take?
we started the beginning of November, and we just finished it last Monday. Is that right?
It was the last day of February, I thought. I mean, I don't know. Could have been early.
No, it was
It was on a Monday.
yeah,
Yeah,
it
it was
was
the
not
3rd. Yeah, the
February.
last Monday, March
Yeah,
3rd.
yeah. We started beginning of November. Just call that what, 5 months, basically. Um,
And to be fair here, like, we had sent them information and we were working on, we had some lease trades in and trade out, so kind of put it on pause. Then we had the holidays we were up against with Thanksgiving, Christmas, and New Year's, and everybody was backed up for whatever reason. It seems to come in waves or something like that. But the level of detail that they were diving into some of the questions on our personal financial statements and
uh,
existing loan balances and DSCRs and how much money do we have in interest reserves for each entity. I mean, Tim and I have over 30 entities, right? So it's like
yeah,
it might not seem like a large task when you got 2 or 3, but when you got 30, it's a huge undertaking to pull all these statements and pull this and do this and analyze that and provide a description and provide documentation. I mean, it is a huge undertaking in order to successfully refinance or to successfully get a loan at this point.
yeah. It's definitely a difficult process, guys. Like, um, when things were hot, and it's so odd to me, by the way, when things are hot and people are overpaying, lenders are just like
Giving money away.
throwing it
Giving it
out
away.
there. But now that things have calmed down and prices are more reasonable, they're way more risk adverse, right?
Yeah,
Um, it's always an interesting dynamic to me how that works. Uh,
I
which
agree. Yeah.
which by the way, kind of maybe speaks to why we end up where we end up every 15 years with loans and stuff. I was, not to get too far off track here, but I was reading last week. You guys watch the movie The Big Short? Tim, you familiar
Oh,
with the
yeah,
movie?
multiple times.
The conference that they go to where Steve Carell stands up and he's like, "I have a question," and he like kind of badgers the guy on stage a couple of times and then
Yeah,
walks out.
yeah.
That conference just happened in Vegas last week,
No way.
and they're saying that it was the most attended conference, the most attendees at that conference since 2006. And
Huh,
they were like, and they're there just trading these swaps again. They're there talking about all these swaps. So they're like, are we back? Are we back to that?
huh. Oh,
And they were like, the last time the conference had this many attendees was 2006. And guess what happened?
2 years
Uh,
later, yeah, the
yeah.
financial crumble.
So it's always interesting to me that, how lending works in cycles like that.
Yeah. Yeah, I mean, it is a lot of it has to do with sentiment, right?
Right.
Um, and how people are viewing the risk ultimately,
Yeah. Yeah.
Um,
Yeah.
eh, at the end of the day, that's what it all boils down to, I mean, literally borrowing money and the spreads that lenders attach to it are their analysis of risk, right? And we actually had this conversation maybe a couple of weeks ago in our coaching group where we were talking about how the rates at that time hadn't really changed a whole lot, but the
Yeah.
spreads tightened. And that was causing the end result, right? So the treasury yields were not changing a lot, but the spreads were changing. They were tightening. And what that told us is that the banks are feeling more confident in the future outlook of where the
Right.
rates will be. And we took that as we think this is a good time to refinance because we found where things are going to stabilize. Now, rates are always going to fluctuate up and down,
Yeah.
right? But my general consensus is I think this is where we're going to stay for the next 12 months. So if we can lock in rate now while we know rates are pretty good, I mean, we just locked rate and refinanced at a 6.01% interest rate.
Yeah.
That's pretty good in my book. I mean, we had some stabilized loans that we had purchased in 2021 that are like 5.5, and now we're at 6. So like I'm good with that. Like if your deal is killed by half of a percentage or 50 basis points, then it's probably not worth doing to begin with. And it is unfortunate, we're still running into some of the same problems with getting constrained on debt coverage ratio. So the loan that we just did, we were approved to get up to 70% LTV on the refi, but our DSCR constraint came into play because at the
Right.
last minute we had to increase some of the insurance coverages to be in compliance with the agency lender. That increased our cost by $10,000 a year, which reduced our proceeds by about $100,000. So we ended up closing that loan with like maybe 65, 66% LTV instead of 70. Um, but we were mostly constrained by, well, we actually were constrained by debt coverage ratio because of cash flow. So bad at the refinance, like, not a great outcome, because we would have liked to have a little bit more proceeds to put some more reserves in the bank. But if you look at the future projections, yeah, rents hopefully are going to start going up from this point, because insurance and taxes have seen a large increase. And now it's time for those expenses to stabilize and
Yeah.
for rents to take some time to catch up. So when we get 3, 4, 5 years down the line and we've had steady rent increases that keeping up with market, we have a fairly low debt coverage, a fairly low leverage percentage, right? Being around
Yeah.
65%. So that just means the refinance wasn't great right now, but the cash flow in the future is going to be better and it'll be
Right.
more safe of an
Right.
investment. So,
Right.
it sometimes it hurts going through it, but at the end of the day, like, a couple of years from now, you're like, man, having that low leverage is pretty nice right now.
Yeah. It's always, Tim, it's always, that was one of the things that kind of like I noticed as we go through underwriting is like what you're talking about at the refi. If you've ever noticed, if you get more leverage at the refi, it actually reduces your equity multiple over the life of the deal.
Yeah.
Um, and it's always, and I was always kind of like, wait, what's going on? And then it makes sense,
Paying
right?
less
Like,
money in interest.
right.
Right.
Yeah. And so it's like, sometimes taking a little less money at refi, and then guys, I'm not pitching this because you always want to cash out as much as you can until, without over
Overextending.
extending yourself. But, I mean, sometimes it's not a bad thing, right? To
Right.
keep to kind of keep that leverage low.
So what I think what drives that the most is people are chasing IRR as much as
Yeah.
possible.
Right.
And in order to get a higher IRR, you have to return as much money as possible at a refinance event or cash flow throughout the life of the deal. If you don't return a lot of money at the refi, your IRR goes down because you
Yeah.
receive more of the money later on in the life cycle of the deal.
Right.
But conversely, you spend more money in interest, so your cash flow is less. And it really is a double-edged sword. It's like you can't have it all.
Yeah.
What's more important to you? Better cash flow and a safer investment and lower risk, or higher IRR, higher risk you know and stress, really. I mean, because when you're running a deal at 20% debt coverage ratio, or 1.2 coverage ratio, if something drastically changes in your costs or your expenses or your income, right?
Right.
You don't really have a lot of buffer there to kind of absorb the difference between where you're at today and where you need to be paying. So, it's not uncommon for deals to drop to a 1.0 debt coverage ratio because of increases in expenses where, maybe rents have declined or flatlined.
Yeah. And it's always, Tim, we always like to talk to folks about like, hey, think of it like a bucket, right? It's all the
Yeah.
same bucket, right? If you take a little more over here, you got a little less for over there. It all comes out of the same bucket or pool or whatever analogy you want to use. And I
Right.
think people sometimes miss that, right? Um, they're like, hey, like you said, you're chasing that IRR. And it's like, but traditionally real estate has been a long-term hold,
Right.
and a long-term hold stable that has a lot of benefits in terms of inflationary hedges and tax advantages and stuff. And I think we lost a lot of, I guess we lost a lot of perspective on that um
Mhm.
over the last few years. So
I think
I
not us specifically. I'm saying the
investor
investor
world.
basis as a
Yeah.
whole, right, has
Yeah.
lost the sight of that. And at the conference, I was talking with Sam Silverman, and we were talking about risk profile, right,
Yeah.
ultimately. And I kind of made the analogy of people put money into stocks and they put it into a stock portfolio and then they forget about it, right? you really need to have the same mindset for real estate as much as you possibly can, because my favorite properties are the ones that I forget the address to, because it's just doing its thing. People are paying every month. It's the vanilla deal stage. I love when deals are in the vanilla deal stage, because that's when you're growing consistently. You're paying down some equity over time. You're probably 95 to 100% occupied with some fixed rate debt, and the business model or the mindset changes. You're not
Yeah.
going after max rents all the time. You're trying to keep it full all the time to manage your expenses and reduce your R&M and vacancy costs.
Yeah.
So the management style is just different when you get to a stabilized product.
And man, I will tell you, as two guys that have been chasing rents for a while, I don't mind. I don't mind some of those easier ones where it's just like, you know what, just renew them.
Going on 4 or 5 years now of chasing rents gets exhausting. I think my
Yeah,
hairline has receded a bit. If we watch some of the videos from 3 years ago, I probably had a bit more hair.
I think I weighed 20 pounds less. So
Yeah.
uh, stress eating.
Um, Stress eating. Oh gosh, yeah. Gotta love them sweets, huh? All right.
Oh, yeah,
So, what we want to talk about now is some strategies to mitigate your rate increases and how we kind of navigate that. Look, ultimately, you don't really have a whole lot of control about it. Sometimes it's luck of the draw. It was funny when we were going through the refi process of our last deal, rates were dropping, and I was texting Tim, and I was like, you know what? I'm glad that we haven't rate locked yet. I'm glad we have, like, keep pushing it as long as we can, because rates keep falling, and it worked out in our favor. And
yeah,
it was a nice win to see the rate drop from, it was like 6.3 to 6% in a week. And I was like, wow, that really kind of helped us out on the loan proceeds. It's really going to help us out on the long term of this deal. Things, sometimes you get punched in the face, and other times things go your way. You know, the best thing that somebody ever told me was, you try to stay even keeled throughout the ups and the downs, because if you get overly excited on the wins and then you get crushed on the losses, like, your emotional roller coaster is so swinging so far left to right that it's unmanageable ultimately at a certain point in time.
yeah, yeah.
Um,
Uh,
but yeah, so
so
I mean, you can try to rate lock as early as you can if rates are low. If rates are high, then maybe you want to push the rate lock as much. Ultimately, in my opinion, it comes down to a little bit of a gamble, and how much risk are you willing to take in order to potentially reduce the amount of rate you pay or increase. I mean, because Tim and I were kicking ourselves. We should have refinanced some deals. What was it, October of last year? And we were like,
yeah,
oh, we think it's going to keep going down. We think it's going to keep going down. And then, like, a week later, they went back up another like 100 basis points. And we're like, damn it, we should have refinanced when rate was like 5.5. Because I think that the 5 year it was what, maybe 3.5.
yeah. I mean, but guys, listen. I mean, at the end of the day, it comes down. This is where bird in the hand strategy really pays off because
The hardest strategy to execute is the bird in the hand.
yeah, because I mean, when you get to a rate that you're good with, that works for you, just take it. Because gambling on rates is a fool's errand. I mean, it rarely pays off.
Right.
For us, you know, waiting a little while did pay off, but it could have very easily gone the other way. Could have
Yeah.
very easily gone the other way. So
It's much like when you're selling a property. If you're okay with making money, sell it. Realize,
yeah,
maybe it's not the most. And trust me, I really struggled with this when I was selling a property of my own. I was like, I should have pocketed another $200,000 off of this deal, and I didn't.
yeah,
But you know what? I made money, and the money's in my account now, and it makes me feel really good that the stress is off the table, and the constant, like, the mental capacity that's opened up by not thinking about trying to maximize this opportunity every single time. It's when you try to squeeze the juice, squeeze it for all the juice that it has. You you know what? I think it's like a setting or something on my camera. I don't know why it does that. Um, when you try to squeeze it for all that it has, you're trying to time the market. And you know what? People always say it's better to time in the market rather than timing the market.
right.
Same's true when rate locking. Like, if you're good with the rate that you have, just lock in, move on with your life, because you're always going to sit there and kick yourself and try to get better rate or do this and maximize every opportunity. But how much stress are you willing to add to your life to accomplish that?
Yeah, put it on, guys. When you get to that rate you like and it works, and you know you got the spread you need, you still got the cash flow that you're good with. Just take that rate and move on. Vitelli said, put it somewhere that you can kind of be like, you know what, I don't have to pay attention to this thing day in and day out. I got freed up brain capacity to go do something else. So
Right.
take it, move on, buy yourself, like we say, buy yourself the time, right?
Buy yourself, no, yeah. I mean, but that's essentially, that was a hard pill to swallow on a couple deals where it was like we told the investors we were going to do a cash out refi, and we were up against an expiring bridge product, and it was like, you know what, just refinance, lock the rate, and let's move on, right? And it's not working out the way that we wanted it to, but we just bought ourselves 5 years to wait and see how this thing turns out. 5 years from now, we might be laughing about how stressed out we were about this refinance or any refinance that we're going through. And it's just, if you're okay with it, you have to lock it and move on. And if it's only one deal that you have, or two or three deals, and it is everything that you have, then yeah, maybe you do want to try to maximize it as best as you possibly can. But when you're operating at scale like Tim and I are, you can't you can't just you can't dwell on it, because there's too many transactions going that if you spend all your time and energy in one transaction, what else is falling apart because you're not giving it the time and attention it needs. So you got
Yeah,
to be good with it. You got to, say you got to have a target. You got to meet your target and then move on.
yeah, yeah. So, and don't and guys, listen, armchair quarterbacking rates, just don't do that. Like I'm guilty of it too, because I'll lock in at 6, and then they'll drop to 5.5. We're like, damn it, I could have
Yeah,
had
yeah,
five
of
and a
course.
half.
Yeah,
Yeah,
that's never gonna go away, but you just have to learn how to live with it. And
yeah,
and and to your point, it's like, bird in the hand. I locked my rate. It didn't get worse. It got better, and good for those that took the risk. But I'm okay with it where it's at. Could have been better, maybe. But you know what? In a couple years, who knows where rates are going to be? Maybe,
really, wait, really good point.
yeah, you're right. I mean, like 3 years from now, maybe rates are 10% and you're locked in at 6, and you're like, oh my God, I'm a genius.
Hey, dude, where I'm sitting right now, I
Oh,
locked in at
right.
2. I looked in at 2.85. 2 weeks later, I could have had 2.6, and I remember going, damn, I could have had 2.6. Guess what? Today they're like 7.
Yeah. Now you don't care about your 2.8 versus
I love my
2.6.
2.85.
Right. It's the best loan you've ever gotten. Right. I mean,
I
my
never want
goodness.
to lose it.
Yeah. But
So,
that's the perspective, right? The hindsight perspective is in the moment, it's very hard to be comfortable with what you have, but you have to look at it as, well, what's it going to look like in 3 years from now, or five
yeah,
years, or 10 years from now? And
right.
if I'm comfortable with it now, just do it and move on with your life, because it's so stressful trying to optimize every single opportunity when you have no control over some of these things, like where rates go.
Yeah. So, hey, another mitigation strategy, right, that you got here is alternative financing, right?
Yep.
Tim and I do this quite a bit. Like I mentioned, we did a refi earlier this year with a couple of our partners. We ended up going with a local bank. We've used credit unions down on one of our properties down in Alabama, and we've used agency financing. But guys, when we go look, we tend to talk to probably at least two, sometimes three different brokers about what the options are in the market. And a lot of times we end up at agency, but there are times when we don't, just because other lenders have better terms, or slightly different terms that we like more.
Mhm.
So don't tie yourself into just one option for sure. I mean, definitely seek what the market has out there available for you.
Yeah, I mean, and there was a conversation that we had was one lender was like 50 to 75 basis points higher on the
Mhm.
rate, but there was no prepayment penalty. And we're like, you
Right.
know what? I
I'll
the
take
rate
that.
is important, but the prepayment penalty is more important to us in this
Yeah.
moment. Or some of the banks optioned were a refinance on a T1, or instead of a T3 or T6, and we're like, hey, you know
Right.
what? With the time that we have, we can only refinance on a T1. So let's do that, because that's going to give us the best bang for our buck. We're going to pay a little bit more. It's a little more flexible, but this is the tool that meets the need right in this given moment.
Yeah.
Agency lenders don't always meet the need every single time.
Right. And I think sometimes what people miss, right? They look at that rate and they forget the points, right? And they're
Yeah, the
like,
points. Oh,
oh, I got a 6% as opposed to a 6.5%. But the guy at 6% is 2 points in and 1 point out.
Yeah.
where the guy at 6.5% is 1 point in, 1 point out.
Right.
And it's like,
Yeah.
maybe you
You
ought
net
to
benefit.
relook at that. Yeah.
Right. You net benefit with the higher rate and less points, right?
Yeah.
So yeah, you really have to have an understanding of your all-in costs.
Right.
But yeah, one thing that's for sure too. I mean, nobody. This is not a secret that Tim and I do affordable housing, but we're working on some other refinances, and we got some really good news back there. And we're seeing, well, the rate was easily 50, 60 bips lower, 50 to 75 basis points lower than our
Mm.
last refinance, and it had up to a 35-year amortization. And
Yeah.
anybody that knows anything about debt coverage ratios knows that the amortization
It's big.
drastically impacts your monthly payment. And if you can stretch out your amortization and reduce your monthly payment, you're going to be able to get more loan proceeds because you're less debt coverage ratio confined.
Yeah, guys, like these are half a point lower with no buy down.
And no buy down. Yeah. What
Yeah.
was I think it was like 2 points on the buy down, but like how much additional proceeds did that give us? And what did it bring the rate down to?
Um,
I think it
I
was like $300,000 in additional proceeds, but I don't
yeah,
know
but
what the rate went down to.
yeah, I think the rate went down to like 5 point, like 1.7 or 5.2 or something like that.
Yeah.
I remember looking at it at first and being like, oh yeah,
Shake my
like,
hand. Is that true?
excuse me, what?
Excuse me, did you, make a typo here?
Yeah, really.
Thanks, Dennis,
Yeah.
appreciate that.
Hey, yeah. By the way, guys, just a quick side note, like not only long term debt, but for the folks out there looking at bridge loans and stuff, bridge rates are coming down too. Um,
Oh, totally. Yeah,
yeah,
yeah, yeah.
I got quoted some bridge rates last week. It's at 7.5.
Whoa.
Uh,
I
yeah,
mean, I know we have some bridge loans now at 8%. I didn't, I didn't know that they were coming down to about 7.5.
yeah,
I mean, I was still budgeting on underwriting files like 10.
yeah. In fact, we did an underwriting for some stuff that we're looking at. I think we were at like 8.5, just because that's what we had gotten recently,
Yeah.
and rates have been dropping a little bit.
Mhm.
And when I sent it to the lender was like, I really think I can get you 7.5 on this. And I'm like, okay, I'm going to keep it at 8.5, but cool.
Yeah.
If you can,
Um,
great.
Last thing I wanna leave off with, Tim, is I want to kind of talk about how and when we know we want to get to a refinance, because some deals we extend the loans, some deals we try to refinance early. So what are we generally looking for when we do a refinance? Like what's our trigger to say now's a good time to refinance?
Oh man, the single trigger.
There's not. I mean, I guess I'll answer it for you. Is it depends.
That's where I was going with that single trigger question. Because yeah, I mean, it all depends. I mean, like for instance, Tim, we were looking at refining something in the Charlotte area, that was coming due in April, and we talked with one of our partners, and we all three kind of agreed, like, hey, let's work on getting the top line a little bit higher, give ourselves 6 months to get the top line a little bit higher, and rates seem to be pretty stable right now, if not just dropping a little bit. So
Mhm. And
let's
one
give
one of the
ourselves a
big
little time.
impacts on that was we get our new LIHTC rates on April 1st. So
Yeah, really good point.
so that enables us to start doing renewals and things like that to kind of push the income up. And
Right.
we're taking a gamble that the rates are going to stabilize here, and trying to maximize the opportunity that we have.
Yeah, exactly. As we're sitting here talking about take what you can get, here we are, like, pushing our timeline 6 months
No,
out.
there's no right answer, right?
No,
I guess the single biggest trigger for me is going to be property performance. There are
right.
properties that we get to a stabilized value or stabilized rent roll, and I'm like, cool, pull the trigger now. And because I'm not willing to risk and wait, because I'm good with where we're at now and I know it's going to get better. So let's lock the rate, and let's lock the refinance proceeds, because we can, some of the interest rate loans that we're in are like 10, 11%. And if I
Yeah,
can reduce it down to 6
yeah,
immediately or
it's
five and a
huge.
half, it's huge. Like do
Yeah,
it now. So,
yeah.
some deals are like race to the finish line. Let's get to the refi as soon as possible. Other deals that are a bit more stable, a bit more operationally stable, and have more potential upside, it's like, maybe I think I'd take
So,
a little bit of a risk here.
so I think it's fair to say, because as we were talking about this, I was thinking about some of the like the tax mitigation stuff that we're doing,
Oh,
and And, I'm like, it really comes down to where you are in the business plan, and then, like if you're looking at an extension for 6 months, how much more of the business plan you think you can do over the next 6 months. If you
Mhm.
are where you are and you really don't think there's much more to get, go ahead. Like today's today.
Yeah.
But like, the tax mitigation stuff is real simple, right? Like, hey, I think I can abate my taxes by 70%, which increases my cash flow by, that amount, that number.
Right.
It's like, hey, I'm gonna take the 6 months.
Right. Right.
Rates may go up a half a point or something like that, but
Right.
my proceeds and my overall cash flow should be much better.
Yeah.
Um,
Cedric, there weren't hard money loans, but they were short-term bridge lenders. So in the
no,
commercial multifamily space, I guess you could consider that a hard money lender, but
mm,
it's a short-term bridge product, but that's just what the going rate was 2, 3 years ago.
yeah, Cedric, when we were getting 10 to 11% bridge, hard money lenders were more like 15%.
Oh, that's
Um,
fair. Yeah, yeah.
yeah,
15 and like 2, 3 points.
yeah. So
So, all right, guys. Well, thanks for joining today. Hopefully, you learned a little bit today about how we look at our refinances and kind of evaluate how the stock market has influenced our rates and what our future outlook is on deals. Well, Tim and I, we're paying attention to this stuff every single day. That's why people trust us to invest their money with us because this is our life. This is what we pay attention to. It's what we enjoy. And we're on top of all these types of things because we know how much of an impact it's going to make for ourselves and our investors. And we're just trying to share some of that information with you guys. So appreciate you joining in, and I will be here next week. Tim Vest is on vacation next week, so he is not allowed to join next Tuesday. So I will see you guys next Tuesday. Peace.